Paul, Christopher, we are halfway through 2015 and the S&P is up a little over 3%. So where do we head from here?
We think stocks head higher from here. Year-end target range for us, 2150 to 2250, call it a 2200 midpoint. Stocks go up. Why? Well, the economy, first of all, leading indicators look good to us 6 to 12 months out. How about earnings? We think the street was too pessimistic first quarter. Our year-end target for S&P earnings, $128 a share. That's significantly higher from where we are right now. Also breadth, 21 out of 27 sectors up over the last year. That sort of breadth you don't find very often. If you go back to 1984, only 18 times have we had 21 out of 27 sectors up in the past year, and that has a median return of around 11%. Furthermore, you really have to give the Fed some credit here. They've been very careful. They've been very patient. We think interest rates move very gradually, very slowly higher, and it won't bother the market, we think, going forward.
All right, so if we are going higher, and you seem pretty confident that we are, what's the best way to play it? Is it large cap, small cap, growth, value? I think growth is really outperforming value this year, so how do you want to do it?
Right, so keep your eye on the economy. We want to play stocks in the way that will best exploit and best leverage the economic growth that we see improving into the end of this year and next year. So what does that mean? We like growth over value, first of all. We like large caps over small caps, secondly. Thirdly, we like those sectors that have the most leverage to the economy. So think consumer discretionary, think information technology, and think industrials going forward. Stay away from the sectors that tend to have more interest rate sensitivity like utilities.
But what if I need yield in my portfolio? I know you want me to stay away from utilities, but I like that yield. Need it, got to live on it sometimes. Where do I find it?
Right. So if you're not satisfied with the Treasury market, and who is these days, another place to go might be REITs, real estate investment trusts. Think about it. Housing market is just now starting to come online as a tailwind for the economy. That doesn't usually happen in the middle of a cycle. With interest rates very low and inflation also very low, the job market is picking up and wages are starting to increase. We think there's a lot of pent-up demand for housing, not just housing even, but commercial real estate too. We think industrials will start using commercial real estate much more than they have in the past, in recent years. And so the demand impact on REITs should be positive. Now you'll say, what about the rising rates? Yeah, rates are going to rise. We think yields will go with them, but very, very slowly. The positive impact from demand, we think, will be more important for REIT investors and more positive than the negative impact will be from rising rates.
And then finally, I kept hearing that I should put my money in Europe and Japan even before here in the U.S. because they're stimulating their economies. They're at the beginning of their QE policies. So should I go there before I come here?
No. So take a step back. We like stocks better than bonds. We like the U.S. better than the rest of the world. So U.S. first, Europe, Japan second, put emerging markets last. The way I would say it is, if I got $5 to put in the markets, I would put the first 3 in the U.S., the next 2 into Europe and Japan, and let emerging wait for the next round.
All right, thanks a lot for coming on.
All right, thanks.
And thank you for watching The Street.